Hi, good morning, everyone, and welcome to Saxo's weekly market outlook call. I'm Charu. I'm the market strategist with Saxo Markets Singapore, and let's dig in. So last week we had the equities close in gains after 3 weeks of losses, and we are now back above 4,000 in S&P. This comes despite the forward upward repricing in Fed expectations and a chorus of hawkish Fed talk. All of the Fed speakers, including also Chairman Powell, who spoke last week, had a very consistent message that inflation remains uncomfortably high and the Fed will continue to raise rates. Many of the Fed speakers have also now clearly hinted that we would potentially see a 75 basis points rate hike in September. And markets seem to be taking that as the base case. Let's bring in Redmond here. Redmond, what's happening in the Treasury markets and how do you see it moving in the equity space?
I think we have been seeing the Fed officials gather around Chair Powell. They all sing a really consistent hawkish chorus and prepare the market for a 75 basis point rate hike for the next FOMC when the Fed meets on the September 21st. And I think, I mean, and then so that is the sort of front end curve of yield curve for 2 to 3 years will continue to be under some pressure, and yield probably may still go a little bit higher to price out the remaining probability of a rate cut in the second half of next year. But 10-year yield and the longer end probably will be quite stable. I think the Fed has successfully, with all those hawkish comments, to rebuild their credibility so the odd for the 10-year yield to challenge and to take out the June high of a 3.5% at the moment seems maybe a little bit low. And so it's but of course, if the bond 10-year yield go above 350, and that would be another new round of pressure on equities.
Absolutely. I think that's why US CPI data is extremely important tomorrow, but we'll get to that later. Firstly, also, let's ask Justin what she's seeing in the technicals here and if she thinks that this rally in the equities could continue.
Yeah, I think that's pretty much what's driving the market of late. So it was really interesting looking at the data. As always, the devil's in the detail. So a couple of key things came out of late showing that volatility is lower. So the VIX index, which basically measures the volatility in the market in the S&P 500, that's at its lowest level in 10 days. So this is supporting bullish sentiment in a bear market. So this is why we're seeing a bear market bounce, and we think that this could continue to run up higher until we see that all important inflation data. But basically what happened and what is happening is several things. So you've got short covering at play. So this is when people are essentially betting that the market has gone down, and they've crystallized by being forced to buy their position so they can actually make money on their short. And the other thing is that we are seeing technical trading. This is supported by the MACD and the RSI, suggesting that the S&P 500 and the NASDAQ could have further legs higher. I think it's also worthwhile to note, if you have a look at the Saxo equity baskets, which we track, this is why we saw a multitude of buying in the risky side of the market. So crypto and blockchain, that sector saw the most gains in the US, up 4%. Bubble stocks also seeing some healthy rallies along with next gen medicine. But all in all, so far year to date, our preferred overweight exposure, commodities is still holding up as the best performer year to date. So basically, sorry. I was just going to say, so just be mindful of volatility picking up, Charu. And I think also what investors and traders need to keep in mind is potentially having their stops, keeping an eye on their stops, and just actually be mindful that this rally is probably just going to be a technical rally until, I guess, something sends the market down, pivoting lower.
Okay, so keep your eyes on the volatility, and of course, very important because we do have US CPI tomorrow. We have European inflation. We have, Chinese activity data due this week as well. So of course, this volatility could move further from here as well. But just back on US CPI release, so Bloomberg forecasts are actually ranging from a negative to a positive on a month-on-month basis after we've had a flat reading in July, along with a softer YOY print as well, which sparked weeks of gains in equities. Now, while commodity prices haven't really been as soft in August as they were in July, so because of that, I do think that there's potentially some scope for a positive surprise there. But in reality, a mild positive surprise may not really change anything, given that the markets have already baked in a 75 basis points rate hike for September. What is really the risk here is a negative surprise, I think, and that could potentially reverse the dollar rally. We saw some glimpses of that in the later half of last week as well. And if we do see a softer print, I think we could potentially see a quicker risk rally in equities as well from here. Also, I think key to watch will be the stickier components of services, of shelter costs. Those were the things that really drove inflation to be higher in the last month as well. So I think an upside surprise there could again, bring back gains in the US dollar still, especially on the back of the Japanese yen that has, of course, it strengthened slightly into the end of last week because of the strong verbal intervention that we've been seeing from the authorities. But as the yields remain so, the yield differentials remain so wide between US and Japan, there's still potential for Japanese yen to weaken from here. Even if they do actual real interventions, it would just really increase some volatility in the pair. But overall, I mean, we do think that there's potential for further weakening in the Japanese yen. And the other key thing I think to discuss from last week would be the European energy crisis as well. At the EU Energy Summit that kicked off on Friday, there were several key issues pertaining to energy supplies and liquidity. All this was discussed, but decisions have been postponed. So really no positive outcome from there yet. Proposals are likely to be delivered into the next week, I think, and I think we'll have to just wait and watch there. Consensus was not there on imposing a price cap on Russian natural gas, which was, of course, key, and there were differences on whether a price cap should apply only to Russia or to other producers as well. So I think tensions are still there because of that lack of consensus, but some positive news came out on the military front, rather, where Ukraine has surprisingly recaptured a key northeastern city from Russia, and it is also making advances in the south. So there are talks that this could be a turning point in the war. Now, how this could play out also is that Russia could increase the energy pressure on Europe, but that's the one to watch, really. Anyway, let's switch gears and then get back to Jessica here in Australia. So Jess, what's happening in the Australian markets? I mean, we had RBA's governor last week saying that the pace of rate hikes could slow from here. And we do have employment data due in Australia this week. So that will be key, certainly. What do you expect there? And, how do you think we can position for that?
Yeah, it's really interesting. Just tackling the first point, so on the RBA pivoting. So the RBA basically said it sees a pace forward of slower hikes. So the market then reacted last week, and we saw the tech index and a lot of tech in ETFs are rallying to their highest levels in 1 week. And this goes back to what we're saying at the moment. The risk on sentiment is supported higher for the short term before the overall market, not just the US, but also Australia, is likely to head lower. So what the RBA basically said and what the market is doing now are two different things. So the futures market, regardless of that pivot last week, Charu, the RBA actually, what they said and what the market, how they responded was two different things. So the futures are now pricing in, that's the interest rate futures, an indication of where the Central Australian Reserve Bank set cash rate will be next year. It's now at 3.6%. So it's a far cry from what the RBA is leading the market and the public to believe that it might potentially slow the pace of hikes. But this week, we get lots of data on tap. Tomorrow, we get consumer confidence, which is really looked at. We know the US and Australia have got a lot in common, and that is that 70% of our economy, just like the US, make their money or make our money from the consumer sector. So this will be really important to watch. The consumer sector has been lagging because interest rates have seen their quickest pace of hikes in history. And then also, of course, the employment data will be watched later in the week on Thursday. We are expecting some job cuts. So we're expecting about 40, or actually, sorry, we should remember the last prior month showed about 41,000 people jobs were taken out of the economy. But so far, as the numbers stand, estimates are suggesting a bit softer job cuts in the order of about 15,000 jobs leaving the Aussie economy. So if the numbers are better than expected, we could potentially see a run up in the AUD USD. But again, it's probably going to be a short-lived knee-jerk reaction. I think the thing to watch here, while we've got the risk on sentiment, is for investors and traders, is to keep an eye on those consumer discretionary stocks, which are being supported amid the short play risk on rally. So that essentially ties it all back in. And then on the same day, on Thursday, the RBA released their bulletin, which is going to be hotly watched as well. So lots on offer this week.
Great. And talking about risk, of course, China certainly is also tightening restrictions further now. And we've seen about 50 Chinese cities are under some kind of restrictions or lockdowns. Let's ask Redmond again. Do you think these restrictions could continue to tighten as we approach the October 16 CCP meeting? And what about the activity data that is due this week in China? Do you think we can see some impact there from these tightening restrictions?
Yeah, thanks, Carol. Yeah. I mean, it's about 50 cities and under certain type of restrictions, and some are actually in full lockdown, but not all of them. But I mean, that is, you are talking about something like close to 300 million people affected, and also about 0.25% of China's GDP. And so, yes, and that is quite a serious issue, and that may not, unfortunately, they may not actually be relaxed after the CCP's, Chinese Communist Party's National Congress, as some of the market chatters at the moment are expecting. And in fact, it's after that important National Congress, there's still a lot of those committee meetings and policy formulation, and many things will not have been finalized until the two section meetings in March next year, mainly especially in the government side, administration side, and some of the personnel issues in the government side, not in the party side. We have to wait until March to be formalized. And so so that's still a very important period politically for China. So, and if of all depends on the development of the COVID situation. If it gets worse, it's unlikely, or if it is not improving, it's unlikely for the government to relax the policy of pandemic control. And just one thing also, talking about the activity data, I would like to also mention a little bit about last Friday after market close. We have the credit data from China. And the government, I mean, the central bank has been urging and giving window guidance to banks to extend more credit to support the real economy, to infrastructure and so on. And we have seen some kind of a little bit of success here in the August data. And because you see medium to long-term loan to corporate actually have picked up nicely. And so if on a month-on-month annualized basis, it picked up something like 16% in this category. So that represent there'll be more credit flowing through to the corporate side, including infrastructure and manufacturing and so on. But at the same time, loans to households still quite sluggish. So especially the medium to long-term loan that represent mainly mortgages. Mortgage loan were still sluggish, and so it's a mixed bag. And the overall aggregate financing is up 10.5% year on year, slightly below last month for 10.7%, but that mainly because of the less bond issuance. So overall is a report showing some success in extending credit to the corporate side, but the mortgage still sluggish. And back to your question about activity data. And I think that now the Bloomberg survey, according to Bloomberg survey, the market probably a little bit optimistic. And in fact, we see some risk of the number coming out this Friday actually might miss the median forecast on the downside. And mainly the reason for that, okay, we just talked about the COVID situation, and then also the heat wave. During August has caused some disruption to manufacturing, especially in Sichuan, and also some disruption or delay in infrastructure construction project in many provinces. And yeah, and one thing on COVID, I would also mention is one of the areas being affected quite seriously is the Yiwu. Yiwu is a city, is a manufacturing hub and also export hub for China. So that will also affect the industrial production, and overall will also may also have a negative impact on retail sales. And also talk about retail sales, and because of the probably market still quite weak, and the data coming out in August. So that is again that will basically we might be seeing some downside surprise in the industrial production, retail sales, and the fixed asset investment number coming out from China this Friday. Yeah, and so maybe Charu and we can talk about it with move on to earnings.
Yeah, sure. While we are with you, let's talk earnings. I mean, we had DocuSign last week, which delivered a beat and also gave better than expected Q3 outlook, and they were up 18%. So what are you watching this week, Raymond, in the earnings calendar?
Yeah, I mean, it's the earning calendar is getting a little bit light already, as most of the US company have already reported. And now is and the Q3 earning has not yet been released, and actually many company will be going into blackout period, so they may not be able to give much guidance and so on. But I think the two notable earnings coming out in the US this week will be Oracle and Adobe, and so Oracle is I think the market will be very much focused on see the core business enterprise software, how good they are doing, and because in front of when they are facing so much competition from the cloud services provided by Amazon and Microsoft. So and also that would be the first time the contribution for one of the new acquisitions, Shenna, and it's a medical information technology provider, that will also be included in this quarter's second quarter's earnings. So that's something the market are watching. And Adobe is basically in the over the last 4 earnings releases, and the guidance outlook rather weak, and so the share price have not been performing. And since the beginning of the year, the share price has tumbled quite over 45%. And but we see Adobe overall has a very good and solid market position. So I think investors will be very watchful to see whether the operating margin can stabilize or may even improve, because of they have done quite a series of actions in doing in cost cutting. And so if they can stabilize or even have some improvement operating margin, and we may be seeing some confidence back to this high quality name. And that's all I think we have in the earning calendar this week.
And just on Adobe as well, it's worthwhile noting that their technicals are suggesting that they could be seeing a bit of a risk-on rally, just like what we were talking about earlier. But Redmond, I just wanted to touch on what you mentioned. It's really important to remember when data sets come out from China, it absolutely has a profound impact on commodity prices and indeed commodity stocks as well. So when that key industrial Chinese data does come out, it's worthwhile keeping an eye on two major key commodities. So the first one is copper, and the other one is iron ore. So speaking about copper as well, the copper futures are currently higher at the moment. So they're higher for the first time in some time. So this is worthwhile keeping an eye on. Remember that that China is the biggest importer of copper, and the copper futures are suggesting that that the copper price could potentially head high. But as always, the devil will be in the detail. But that's probably for traders to potentially consider if they did want to potentially look at that before the data set does come out. And then investors might potentially take some affirmation from the data if the data is indeed better than expected. And they could potentially look at some of the world's biggest copper companies, of which we've detailed on our resources basket. But the other thing, sorry, Charu, just before handing back to you, the other thing that's worthwhile noting is today, in apprehension of perhaps possibly better than expected data out of China later this week, we are seeing the iron ore price move up for the third straight day. So it doesn't mean much, but it is back above $100. Pardon me, back above $100 for the first time in a week. So this is a key psychological level. And if we do see the iron ore price move further above $100, we could see an extension of a rally here, and technical traders could get in as well. Also, just finally on iron ore, keep in tow that the MACD and the RSI are suggesting further upside is here. But as always, it depends whether you're a trader or investor, how you wanted to play this, but that's something to consider. Back to you, Charu.
Great, thanks, Jess. And of course, in terms of copper, I think the focus is also a lot on the supply issues now with the disruptions that we're seeing in Chile. So of course, that's something very interesting for traders right now. But I think usually we would just wind up here. But just to get you up to speed about, we had these interesting events in Hong Kong and Singapore last week called the Saxo Unfiltered. We had a host of speakers and also panel discussions there. It's also happening in Sydney tomorrow. For those of you who are based in Australia, we could not get around to a lot of the audience questions that we got there at those events. So we will take some of them in these morning calls from here. We'll try to limit it to one or two every Monday morning. So perhaps since we're already running a bit over today, I think we'll just take one today. And probably, Jess, you want to come in on this again? Someone had asked us which equity sector should we invest in now. I think we did answer that earlier when Jess was talking about the technicals, but let's just summarize with that and end it there.
Yeah, great question. That's probably the favorite question that the three of us get answered, and more broadly across the team as well. But just reiterating, our preferred theme or exposure at the moment is commodities, and the subsector of commodities that we're liking at the moment is energy, and that's purely because what we're speaking about, a lot of our commentary of late, and that's because the energy crisis is only getting worse, and this winter in Europe, they are set to run out of energy, and this is why we're seeing the gas price consistently move higher, just on the back of the supply-demand imbalance being really off. In saying that, though, in an energy crisis, we do see typically all energy sources rise because people are and countries and companies are scurrying to shore up energy. So this is perhaps why we saw Germany, California, etc. They're all getting ready to fire up coal-fired power stations for different sets of reasons. But again, just tying it all home out, if you look at our Saxo equity baskets, which are available once you've logged in, if you click on stocks, you'll be able to see the equity baskets, and then you can click on commodities and see the stocks based on market cap. They've got an equal weight, and you can have a look at some inspiration there for some key commodity plays. But that's
I think also just to add here, I mean, of course, we're also in addition to commodities, I think some of the other things that we particularly like here at Saxo would be defense, cybersecurity, and the India baskets as well. So of course you can go back to the platform and explore these baskets in the research tab out there. But yes, I think that's it from us today. And thanks for dialing in. And don't forget to reach out to your relationship managers if you do want to schedule a one-on-one markets discussion with SaxoStrats. And have a good day. Have a good trading week ahead.
Bye, everyone.